Hi, Brad Macbeth here. Thanks for joining me today. I've been a private equity advisor for a number of years now, and we just want to look today at why people are turning to private equity and what it means for their portfolios. Let's take a look. Over the past 13 years, since the beginning of the year 2000, the Toronto Stock Exchange has achieved a year-over-year growth of a mere 1.62%. And this includes dramatic downturn periods from the year 2000 to 2003, and again from late 2007 till early 2009. The broad index of US stocks, the S&P 500, has fared no better and in fact a little worse at 1.35% over the same time period, not even beating inflation. With similar downturns from 2000 to 2003 and again the big shock from late 2007 till early 2009. The iconic Dow Jones Industrial Average has fared slightly better at 2.23% over the same 13-year period. A big note though, from the year 2000 until March 2009, the index was actually down 37%. There's a dirty little secret hiding here though. Stocks that form these indexes are selected for relative size, which is affected by performance. Stocks are removed and added from and to the index according to size, so poor performing stocks are taken off the index. What we really want to know is real performance, measured against inflation for all stocks in a market. When we look at this, the real story on the New York Stock Exchange, from August 2000 to April 2013, there was zero real return without inflation adjustment. From July 2007 to April 2013, the index actually dropped 3.89%. For Canadians, if we factor in the drop in the US dollar from August 2000 to August 2013, that actually comprises a 32.5% drop for Canadian investors in US stocks. The actual inflation-adjusted return over 47 years for all stocks on the New York Stock Exchange is a mere 1.85%. So what are professional investors doing about this? Let's take a look at what some of the people managing the biggest pools of money in the world are doing. At the Ontario Municipal Employee Retirement System, Michael Nobrega is part of the movement shifting over to private equity. OMERS began this shift in 2004. They serve 400,000 members in Ontario and then had an investment mix of 82% public and 18% private investment holdings. With their new strategy, their asset goal became 53% public market and 47% private holdings. They did this primarily because they wanted to lower their exposure to volatility in the public markets. The Yale Endowment Fund, which returned an investment return of 21.9% and it runs at $19.4 billion, has now shifted to 34% private equity and 20% real estate in their holdings. And over the past 10 years, the top 10 US pension funds have returned between 12.7% and nearly 16% in private equity return within their portfolios. So what prevents conventional, or what I call retail investors, from getting these types of returns? It's all the hands that an investment passes through when it turns into either a public stock or a mutual fund or a segregated fund. From business owner to IPO, through different financial institutions, broker networks, etc., 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 till it finally gets down to the advisor and the client. At every layer, there are fees being added that are taking away from the return that should be going to the investor. So what should investing look like now for a conventional investor? Well, probably 25% equities, bonds, 20% real estate, 10% alternatives and real assets, and some suggest 10% cash. But how is a conventional investor supposed to get access to all of these asset classes? You might be able to find equities and bonds at your local bank or through your conventional financial planner or financial advisor. But what about real estate and alternatives and real assets? Where can we get our hands on those and put them in our portfolios? We can get them from other kinds of advisors called exempt market advisors, and some asset classes you can buy directly from the investment issuer. In the example shown here, the fortunate investor achieved a 22% return in approximately 8 months in a real estate income trust. This is just one example of many types of private equity investments that people are turning to enhance their portfolios. Thanks for taking some time today to listen to our comments about private equity. We'd love to share more of what we know with you. Please feel free to drop by our website, macbethmick.com, or give us a call. The information's at the bottom of your screen. Also happy to have you subscribe to our monthly newsletter of tips and information on how you can take advantage of private equity markets. Thanks very much and have a great day.